Hello and welcome to this session on derivatives where we will cover the benefits and risk associated with derivatives. In this session you will learn about profiting from derivatives, purpose and benefits of derivatives, and risk involved in derivative trading, including a case study on the Lehman Brothers collapse. If you are looking for a trading option outside of a traditional stocks and bonds, derivatives trading may be a good option. Let's explore some of the benefits of derivatives trading. Today's sophisticated international markets have helped foster the rapid growth in derivative instruments. In the hand of knowledgeable investors, derivatives can derive profits from the changes in interest rates and equity markets around the world, the currency exchange rate shifts, and the changes in global supply and demand for commodities such as agriculture products, precious and industrial metals, and energy products such as oil and natural gas. Adding some of the wide variety of derivative instruments available to traditional portfolio investments can provide global diversification in financial instruments and currency, help hedge against inflation and deflation, and generate returns that are not correlated with more traditional investments. Coming to the benefits of derivatives. The two most widely recognized benefits attributed to derivative instruments are price discovery and risk management. The other benefits are reduction in market transaction cost and improvement in market efficiency for the underlying assets. We will now learn about these benefits in greater detail. Price discovery. Futures market prices depend on continuous flow of information from around the world and require a high degree of transparency. A broad range of factors such as climatic condition, political situation, debt default, refugee displacement, land reclamation, and environmental health, for example, impact supply and demand of assets and commodities in particular. This kind of information and the way people absorb it constantly changes the price of a commodity. This process is known as price discovery. In other words, price discovery is a method of determining the price for a specific commodity or security through basic supply and demand factors related to the market. With some futures market, the underlying assets can be geographically dispersed, having many spot or current prices in existence. The price of the contract with the shortest time to expiration often serves as a proxy for the underlying asset. Second, the price of all future contracts serve as prices that can be accepted by those who trade the contracts in lieu of facing the risk of uncertain future prices. Options also aid in price discovery, not in absolute price terms, but in the way market participants view the volatility of the markets. This is because options are a different form of hedging in that they protect investors against losses while allowing them to participate in the assets gain. As we see later, if investors think that the markets will be volatile, the prices of option contracts will increase. This concept will be explained later. Moving on to risk management, which could be the single most important purpose of the derivatives market. Risk management is the process of identifying the desired level of risk, identifying the actual level of risk, and altering the latter to equal the former. This process can fall into categories of hedging and speculation. Hedging has traditionally been defined as a strategy for reducing the risk in holding a market position, while speculation refers to taking a position in the way markets will move. Today, hedging and speculation strategies, along with derivatives, are useful tools or techniques that enable companies to more effectively manage risk. Derivatives also help reduce market transaction cost because derivatives are a form of insurance or risk management. The cost of trading in them has to be low, or investors will not find it economically sound to purchase such insurance for their positions. Finally, derivatives also improve market efficiency for underlying asset. For example, investors who want exposure to S&P 500 can buy S&P 500 stock index fund or replicate the fund by buying S&P 500 futures and investing in risk-free bonds. Either of these methods will give them exposure to the index without the expense of purchasing all the underlying assets in S&P 500. If the cost of implementing these two strategies is the same, investors will be neutral as to which they choose. If there is a discrepancy between the prices, investors will sell the richer assets and buy the cheaper one until prices reach equilibrium. In this context, derivatives create market efficiency. In short, derivatives trading can be an excellent way to either break into the trading market or to round out an existing portfolio. It offers a wide range of options, including international opportunities. Finally, with some skill and research and bit of luck, it can be a good way to make your money work for you. Moving on to the risk associated with derivatives. Investors must understand that investment in derivatives has an element of risk and generally not an appropriate avenue for someone of limited resources, limited investment, and or trading experience and low risk tolerance. Remember that Warren Buffett quote on derivatives being a weapon of mass destruction, right? Lack of transparency has been highlighted as a key risk in OTC derivatives market. Positions and exposure of firms in OTC derivative markets are not sufficiently transparent to other market participants or to regulators. Market participants are unaware of overall market positions and build-ups in risk. This lack of transparency in relation to overall exposures can lead to an unwillingness to trade in a falling market and thereby reduce market liquidity. The lack of transparency means the supervisors are not able to monitor or mitigate systematic risk effectively. In addition to the lack of transparency, the main risk associated with derivative contract is counterparty risk. That is, the risk that a counterparty in a derivatives contract will not satisfy its obligation under the contract. For example, by failing to supply goods in a futures contract, this could cause major problems to a counterparty that would be left suddenly without a derivatives contract and no longer receiving payments under the contract. In practice, large market participants use various techniques, including the posting of collateral either through mark-to-market margins, variation margin, and upfront margins, initial margin, to reduce counterparty risk to which they are exposed. Both operational and systemic risk affect derivatives contract. Operational risks are those that occur from human error or the failure of control systems. These are standardized contract terms for OTC terms. Improved process and procedures for the physical settlements of underlying assets and procedures for addressing valuation disputes have helped reduce the operational risk. Systemic risk describe the risk to the financial system posed by the default of major player in derivatives market. Interlinkages in market created by large number of derivative contracts means that the default of one party can have far-reaching implications for the creditworthiness of its counterparties. Derivatives have been associated with a number of high-profile corporate events that roiled the global financial markets over the past 2 decades. To some critics, derivatives may have played an important role in near collapses or bankruptcies of Barings Bank in 1995, Long-Term Capital Management in 1998, Enron in 2001, Lehman Brothers in an American International Group AIG in 2008. It is believed that OTC derivative tradings were thought to have played some major role. In 1995, Barings collapsed when rogue trader Nick Leeson lost $1.4 billion, which is more than twice its available capital in trading equity derivatives. The amount involved with derivatives-related corporate distress in 2000s have increased substantially. Enron's filing for bankruptcy in 2001 took many commentators by surprise. At that time, the company was estimated to have a shareholder value of $70 billion. The core of Enron's business was dealing in derivative contracts based on the prices of oil, gas, electricity, and other variables in OTC market. Enron's derivative transactions in these markets were largely unregulated with no reporting requirements. There was little information available about the profitability of these derivative activities. Some thought that speculative losses in derivatives, perhaps masked by creative accounting, was one of the main contributing factors to the collapse of the company. Let us now closely examine one of the biggest derivative-related collapses of all times. We all have heard of financial services firm Lehman Brothers going bust. But what exactly happened? Lehman filed for Chapter 11 bankruptcy protection on September 15, 2008. The filing remains the largest bankruptcy filing in US history, with Lehman holding over $600 billion in assets. Lehman was the fourth largest US investment bank at the time of its collapse, with 25,000 employees worldwide. Lehman's demise also made it the largest victim of the US subprime mortgage-induced financial crisis that swept through the global financial markets in 2008. When it filed for bankruptcy protection in September 2008, Lehman Brothers was an active participant in the derivatives market and was party to 906,000 derivative transactions of all types under 6,120 ISDA master agreements with an estimated notional value of $35 trillion. The majority of Lehman's derivatives were bilateral trade agreements, not traded on an exchange but in over-the-counter OTC market. Because derivatives enjoyed an exemption from automatic stay provisions of the US Bankruptcy Code, parties to Lehman's derivatives could seek resolution and self-protection without the guidance and restraint of bankruptcy court. The rush of counterparties to novate or substitute Lehman's derivative contracts and the confusion following the contracts that were terminated after its bankruptcy filing added to the stretch of financial crisis. Lehman borrowed significant amounts to fund its investing in years leading to its bankruptcy in 2008, a process known as leveraging or gearing. A significant portion of this investing was in housing-related assets, making it vulnerable to a downturn in that market. One measure of this risk-taking was its leverage ratio, a measure of the ratio of assets to owners' equity, which increased from approximately 24:1 in 2003 to 31:1 by 2007. While generating tremendous profits during the boom, this vulnerable position meant that just a 3 to 4% decline in the value of its asset would entirely eliminate its book value of equity. In 2007, the firm reported the net income of record $4.2 billion on the revenue of $19.3 billion. In 2007, the firm reported net income of a record $4.2 billion on revenue of $19.3 billion. In 2007, Lehman underwrote more mortgage-backed securities than any other firm, accumulating an $85 billion portfolio, or 4 times its shareholders' equity. However, by the first quarter of 2007, cracks in the US housing market were already becoming apparent as defaults on subprime mortgages rose to a 7-year high. In 2008, Lehman faced an unprecedented loss due to the continuing subprime mortgage crisis. On June 9, Lehman announced a second quarter loss of $2.8 billion. On Monday, September 15, Lehman declared bankruptcy, resulting in the stock plunging 93% from its previous close on September 12. Lehman's bankruptcy led more than $46 billion of its market value being wiped out. It also triggered a cascade effect across Wall Street. Within days, the insurer AIG had to be bailed out by the federal government, while other investment banks, including Morgan Stanley and Merrill Lynch, were pushed to the brink. Many years on since the Lehman collapse, the big question is, are we any safer? The Dodd-Frank Act tackled a myriad of market flaws that were made evident by the crisis. Most derivatives are moving out onto exchanges and central clearing houses where risk is more transparent and can be managed better. Securitization procedures are being improved, although there is more work to do there. The main challenge to policymakers, therefore, is to ensure that derivative transactions being properly traded and prudently supervised. This entails designing regulations and rules that aim to prevent the excessive risk-taking of market participants while not slowing financial innovation. Those who are interested in learning more about the Lehman and the global financial crisis should watch the movie Too Big to Fail. With this, we reach to the end of this session. We hope you understood the pros and cons. I look forward to seeing you again soon. Thank you and goodbye.